Hi, this is Chris O'Shea, Chief Investment Officer here at the Financial Consulate, coming to you. It's the 24th of February. It's a little after 2:30. It's actually a month to the day from the last update. Market volatility, again, continues, and it spiked, obviously, today with the crisis of the invasion of Ukraine. Clearly a human tragedy, and for the people of the country and the peripheral folks. So any war is just horrible. There's nothing good about it. And so we want to give you an update. What does it do for our portfolios? What does it do for the managers that we're using? What does it do for you as a holder of assets? How should you be viewing this? Because we've seen reporting on this for the last several weeks. The media has been talking about this all the time, the 24-hour news cycle. And so the human side of it is truly bears reporting on. Anything that can cause the Putin to change from where he's going, is certainly encouraged. But from a market standpoint, we want to put things in perspective. This is Russia and Ukraine. NATO has already clearly said Ukraine is not part of NATO, so NATO is not going to be drawn into this. They're going to be bringing pressure to bear, economic, military, with supplies to try to end this quickly. But from an economic standpoint, market standpoint, markets have already declined. You've seen the S&P was down 11% as of last night. And today it was down another 2.5% before the market rallied. Last check, it had broken back to even. So, but beneath the surface, there's over 56% of the stocks as of last night at the S&P were down over 20%. For the NASDAQ, almost 60% were down over 50% as of last night. So you've got this, the Federal Reserve with inflation has come in and clearly signaled that rates are rising. The market has, predicted how far they're going to go. They've already risen rates. So bonds have lost value so far this year. And so anytime the Federal Reserve changes tack, and from a point of being accommodated for all these years, and they're changing and then now pulling money away, as in 2016, 17, 18, you saw rates rise, and markets after a point thought it was too fast. But again, after a time, rates rising is a good thing. Inflation is not a good thing. And so for now, Federal Reserve, inflation, you've seen markets react. But they've reacted significantly already after a full market for 19, 20, and 21. This is not unusual. It always comes with uncertainty. But we know that our managers, bond managers and stock managers, are looking for opportunities, because although war brings, the beginning of it brings short-term volatility, it also quickly turns into some outstanding opportunities for things that have been devalued along with everything else, where it's been overdone. So these are difficult times to do that as an investor, but we're not changing our perspective on where things are. It makes the Fed's job a little more complicated, I think, going forward, but that's what they're in the business to do. And we believe that they'll do their best. And depending on how successful they are, that could change some of the movements of markets. But financial system, because of the Fed's accommodative stance over the last 12 years, is as strong as it's ever been. Banks are as strong as they've ever been. The consumer is probably as flush as they've ever been. And so savings were going up. People have been spending it. The consumer spending continues to be strong. It looks to continue. And so right now, the longer term prospects for the economy and market appear to be strong. It looks like, again, the short term challenges with the Federal Reserve is approaching. And now the things that are happening globally, geopolitical politics are always complicated. We've got an overt Cold War going on right now with Russia officially, right? And we had one really a couple of years ago starting with China. So these are scary events, but it doesn't look that it's going to escalate beyond political maneuvers. And so right now you've got Russia invading Ukraine. So again, we think that there are opportunities. We encourage people to just remember the long-term perspective. And so that's why we don't put most people's money fully in stocks. For those who need money to live off of, we're drawing from the bonds. This is the exact reason that you keep those. Bonds have rallied today, right? Because in times of uncertainty, people rally to the U.S. Treasury market, and that's what's happened. So bonds are up. And so we will continue to look for opportunities and encourage you, if you want to hear more, our CEO and founder, Mike and Drew's monthly update will be coming out within a couple days. So we encourage you to tune into that. If you have more specific questions, by all means, reach out to me or to your relationship manager. And until then, we wish you the best.